The House Oversight Subcommittee on Corporate Subsidies and State Investments will come to order. Will the clerk please take the attendance?
Chair Cara.
Here.
Representatives Green.
Present.
Bierlein.
Here.
Legella.
Here.
Bohetsky.
Here.
Mr. Chair, you have 5 members present, a quorum.
Representative Bierlein moves to approve the minutes of the March 5th meeting. Hearing no objection, they are approved. Today we will be hearing a presentation on megacredits. I will welcome Mr. Ben Gilchek from the House Fiscal Agency. If you'd like to take the stage, we look forward to hearing more about megacredits today. Thank you for coming.
Thank you, Mr. Chair, members of the committee. My name is Ben Gilchek, an Associate Director with the House Fiscal Agency. Just a little housekeeping to begin. Here's a brief background on the House Fiscal Agency, basically what we do and what our purpose is. As an agency, our overarching mission is to provide objective, nonpartisan expertise to the House of Representatives on legislative fiscal matters. This includes budget, economic and fiscal analysis, economic and revenue forecasting, and concise, nonpartisan summaries and analyses of bills. The work serves the purpose of assisting legislators in making budget and policy decisions, enhancing accountability and transparency in government, and providing analyses that support legislative deliberation. I would emphasize that we do not provide opinions on or recommend policy. Rather, our goal is to inform policy discussion. So I'm here today because I was asked to provide a brief history and background of the Michigan Economic Growth Authority Tax Credit Incentive Program. The following slides will discuss some of the history and pertinent details of the program structure and provide some data on tax credit usage and revenue impacts. The MEGA program was established in 1995 to attract, retain, create, and increase job and capital investment in Michigan in response to interstate competition for jobs and business investment. The MEGA credits are refundable, performance-based tax credits that were awarded for up to 20 years in some instances. Just a reminder, when we say a tax credit is refundable, it just means that if the credit award is greater than the tax owed by the business, the state will pay the cash difference to the company as a refund, thereby lowering the net business tax revenues in this instance. The performance-based nature required companies to meet agreed-upon conditions around investment and job growth to qualify for the credit, and the value of the credit corresponded with job and investment levels actually produced. So put another way, the calculated amount of the tax credit was a function of performance with these credits. Initially, the credit supported job creation and investment in Michigan. However, this eventually expanded to include job retention. As the name implies, the state provided a tax incentive to companies that agreed to retain specific numbers of jobs in the state and meet agreed-upon investment amounts. The value of the tax credit awarded in any given year was not capped, but there were some limitations on the number of yearly credits that could be awarded. I'll touch on this a bit more in a few slides, but there was a new credit formula adopted in 2008 for retention credits that led to increased credit liability. And lastly, about 2/3 of the total value of all credit agreements entered into over the history of the program occurred between 2008 and 2011, which is basically done in an effort to save manufacturing and other jobs in the state of Michigan during the Great Recession. I have some charts toward the end of this presentation that will also highlight sort of that magnitude. Mega credits were ultimately discontinued in 2011, along with the discontinuation of the Michigan business tax and implementation of the corporate income tax for C corporations. However, companies with existing credits could continue to claim the credits by filing under the MBT, and credits could continue to be amended during this time. Of the remaining certificated credits, mega retention credits clearly have the largest impact on general fund revenues, and they are expected to continue through fiscal year 2032. I will note that once mega tax credit agreements were discontinued back in 2011, a much smaller business incentive program was created called the Michigan Business Development Program. And here's a brief slide discussing that program. It still exists today. The Michigan Business Development Program is funded in the Annual Appropriations Act and is used to award grants and loans to businesses that agree to create new jobs and investment in Michigan. With this structure, the award amounts are known up front, and the appropriation cap in any given year is set by the legislature through the budget process. Historically, the annual appropriation for the Business Development Program has been less than $100 million. And I would also note that awards under the program continue to be performance-based, meaning job creation and investment targets must be met before the award amounts are dispersed. So getting back to mega tax credits, in the early to mid-2010s, the state encountered issues around the unpredictability of the mega credit redemption and their estimated and actual value. amendments that increased or decreased in a few instances the value of the tax credit, complications in estimating and forecasting the credit, and the timing of certificate redemption all played a part in this uncertainty. Those concerns led to changes to the mega tax credit program in the mid-2010s, mainly to improve estimating and limit uncertainty around mega tax credit value and redemption timing in state fiscal years. Amendments that increased the overall value of the credit were prohibited. I will note that amendments that added flexibility, for lack of a better word, in meeting tax credit conditions and amendments that were purely technical in nature were still allowed. An effort was also made to ensure that credits are filed with the Department of Treasury in the year they are certified. This was an effort to prevent businesses from filing multiple years of credits in one fiscal year, thereby causing revenue forecasting issues. There were also improvements in estimating credit value. Early estimates used an average wage and didn't include growth factors, leading to initial estimates that understated the total value of the credits by a fairly significant amount. But since the mid-2010s, estimates of tax credit liability have included growth factors around things like jobs, wages, and benefits, and the mega credit liability estimate is included in the consensus revenue estimating process every January and May. Lastly, there have also been revisions to individual agreements in the past decade that have lowered in-cap liability, improved revenue impact projections, altered wage requirements for the credit, and required certain investment levels. This slide just shows 4 or 5 of the main mega tax credit types. The high-tech, high-wage mega primarily supported high-tech activity or a qualified high-wage activity. Those are listed in the bullet underneath there. Generally speaking, it needed to satisfy 5 new jobs in the first year and 25 by the 5th year. And for the high wage credit, it must pay at least 300% of the federal minimum wage. There was a rural mega credit supported eligible businesses in a county with a population of 90,000 or less. Again, 5 new jobs by the first year and 25 by the 5th minimums. The retention mega credit supported existing businesses located in the state who agreed to certain conditions regarding capital investment and number of jobs to be retained. There was a requirement that $50,000 in investment per retained job to qualify for this credit. And then the standard mega supported eligible businesses that proposed to create qualified new jobs in those listed industries in that bullet there. And again, it needed to create at least 50 new jobs in the first year. Here's the spectrum of industries on the receiving end of mega tax credits: advanced manufacturing, advanced manufacturing, automotive manufacturing, and R&D, and information technology were the largest areas. But as you can see, the awards spanned a wide range of industries. I don't have specific information related to the value of the credits by the sector, but I believe the automotive-related tax credits had the highest overall value. This slide just shows a listing of other MBT certificated credits outside of mega, and really the year in which the credit was or will last be earned. You can see there was a brownfield tax credit last earned in fiscal year 2018, historic preservation certificated credit, Renaissance zone. You can see the listing there and sort of when those were earned. I do have a slide at the end of this presentation that provides the annual revenue impact of each of these certificated credits, including mega, for the period between fiscal year 2016 and 2032. So moving on to the mega tax credit process. This provides a general look at how the mega application and award process would look. A company applies for an award and an agreement is reached on specific terms of the incentive. The Michigan Strategic Fund Board, previously the Mega Board, approves the award. The company pursues investments in job creation or retention in each year of the award pursuant to the agreement. The company then applies for a credit certificate certifying compliance with terms of that agreement in each year over the term of the credit. The MEDC staff verify compliance with the terms of the agreement and issue a certificate. The company then submits the tax return with the associated certificate. The Department of Treasury reviews that tax return and issues credit refunds. And then throughout the term, there may be amendments sought by the company, and those must be approved by the Michigan Strategic Fund Board. Just some highlights on mega credit calculation examples. I included the main retention credit formulas here. They were the credits with the largest revenue impact. Generally, the pre-2008 retention formulas included job numbers, wages, and the income tax rate. You would simply take the product of the jobs, multiply by the wages of those jobs, and multiply that by the statutory tax rate to get a credit amount. There were also some investment conditions pre-2008 that would adjust the overall value of the credit. The company would receive up to 50% of the credit if they invested at least $250 million and retained 500 jobs. The company would receive the full credit if they invested $500 million and retained 500 jobs. post-2008 retention formula added healthcare costs into the calculation and adjusted the investment conditions, which generally increased the value of any similarly situated credit. Additionally, as I discussed previously, the early estimates didn't factor in wage and investment growth when estimating the initial value of the credit. Early estimates of the credit value treated wages and investments as averages or sort of static amounts. Recognizing that wages, healthcare, and investment can and likely will increase over the term of the credit led to an increase in the estimated and actual value of the credits over the term horizon of all credits. Lastly, I will note that over the past decade, there have been slight revisions in credit calculations for individual agreements, but the tax credit value is generally a product of wages and healthcare, of retained jobs, statutory income rate, and investment. The next few slides will look at agreement and award history. I'll cover mega agreement approval amounts by year, basically the total value of the agreements signed annually through the program expiration in 2011. I've also included some data on the number of certificates issued and the number MEDC is expected to issue over the remaining years. And lastly, I've included some data on the annual value of previously issued tax credit certificates and the expected annual value of future certificate issuances. This table represents the number of mega awards by type, which were described earlier on a pure number awarded basis. You can see that standard credits were the most awarded type of credit over the history of the mega program, followed by high-tech mega credits, retention credits, and then rural credits. However, while retention credits only comprised about 11% of the total number of agreements, they made up about 2/3 of the total tax credit award value. As I've noted there at the bottom, according to the most recent mega and other certificated credit report, the total mega tax credit liability, meaning the amount awarded like in the past, and the remaining liability looking forward is about $9.4 billion. Here you can see the value of agreements approved by the fiscal year. The blue represents mega job creation awards and the green represents mega job retention awards. As I noted on the prior slide, retention awards made up approximately 2/3 of the value of all awards, at least when you use the value at the time of approval. Also evident in this chart is the fact that 2/3 of the total value of mega tax credits, both retention and job creation, over the history of the program were awarded between 2008 and 2011 in response to the Great Recession. Lastly, I would point out the period from 2011 to 2014, which technically goes beyond the program expiration. No new agreements were entered into, or rather that represents amendments to existing agreements that change the value of the agreement. Most of the amendments over this period increased value. There were at least one that decreased the value of a credit. I will remind you that amendments that increased the net amount of an agreement were prohibited after 2014. Here you can see the number of certificates issued per year over the history of the program. A certificate is awarded each year under the terms of the agreement. For example, a 10-year mega tax credit agreement entered into would have 10 certificates spread over 10 years. What I would draw your attention to is that while the number of certificates issued peaked in 2011 at 216, you will see that in a couple slides that the value of certificates awarded in a given year did not hit its peak until later in the 2010s. What will be evident is that the number of certificates issued in a given year does not necessarily correlate with the value of certificate issued in that year. In fact, even after the fairly dramatic drop-off in the number of certificates issued after 2011, the claimed amount or expected liability remained near historic highs. I could have added this slide to the prior slide, but the scaling would have maybe, you wouldn't be able to see it considering the scaling on the last one. This is future looking. The prior slide was history. This is essentially the estimate of certificates that the state will issue in future years. I will note that there is a 2-year lag between when the certificate is issued and when it affects revenues. So for example, the 9 certificates listed there for 2024 will ultimately lead to revenue loss in 2026, fiscal year 2026. What you can see here is that the credits end by 2030 or the fiscal year 2032 budget year. I noted this on the previous history slide, but you will see in the next 2 slides that even though the number of certificates issued in a given year going forward is less than 10, the value of those certificates remains relatively high. This slide represents the annual value of certificates issued based on the tax year in which the business activity occurred. Remember from the last slide, the year in which the issued certificate is certified, redeemed, and refunded by Treasury usually lags by 2 years. So on the far right column there in 2022, the value of those certificates showed at about $500 million would be certified and redeemed in fiscal year 24 and affects revenues in that year. Also remember from the past two slides that the number of tax credit certificates issued declined substantially after 2011, sort of right in the middle of that slide as you start to see the increase. Yet as this chart indicates, the value of credits remains steady at historically high levels. This slide continues the prior slide and is forward-looking. These bars represent the value of certificates the state expects to issue annually over the life of the remaining tax credits. The total amount outstanding, if you added all those bars up, is about $3 billion. Again, these represent company tax years. The fiscal year in which the revenues are impacted is lagged by 2 years. The bar showing $506 million for 2023 is what we estimate will be certified and redeemed in the current fiscal year, or fiscal year 2025. If you remember from 2 slides ago, there are fewer than 10 tax credit certificates that are expected to be awarded in each of these fiscal years and each of these years, and that should give you some indication of the individual size of the remaining credits. No credits will be earned beyond 2030, and tax credit redemptions are expected to cease affecting revenues in fiscal year 2032. Sort of hinted at this slide. I just included this slide to provide you a summary information on certificated credits, not just mega certificated credits. This is table 3 from the 2024 mega and other certificated credits annual report. The entire report is public and updated annually on the MEDC website, and I provided a link to it back on slide 16, and I'm happy to share with members after the meeting. This represents the certificated credit value by the year in which they did or will impact revenues. As you can see in the table, after fiscal year 2027, when it's expected that the last brownfield tax credit will be claimed, mega and farmland preservation credits will be the only MBT credits remaining. And with that, I'm happy to take any questions.
All right. Looks like we have our first question from Vice Chair Green.
Thank you, Mr. Chair. I'm just, since second term here, so a lot of this happened before, I'm just trying to follow the timeline of the history of this and just make sure we're all fully informed. What happened in 2011? Is that when we went from the old system to the new system of the tax credits?
So in 2011, MBT tax credits were eliminated. The MBT went away and it was replaced with the corporate income tax. And existing tax credits under mega or other certificated credits could continue to be claimed, and the taxpayer would have to file under the Michigan old MBT through the exhaustion of those tax credits. So it was a way to allow that taxpayer to continue to claim the credit that was awarded prior to 2011. But 2011 really marks the transition from the MBT to the corporate income tax structure.
Okay, but then as I'm looking here, then we had this jump in 2011 on your page 20, that then the value of the certificate, so we had this other program, that's why I'm seeing 2011 was the year that then something else happened, and that's when the big cash started getting doled out.
So I guess I would start that there was a significant value of credits awarded between 2008 and 2011. And the term of those credits sort of could range up to 20 years. So a credit that was issued in 2010, and those were the most sizable ones, came in 2008 to 2011. So that's why you see the value of the credits really spike on that slide in 20. So like they gave them a 20-year tax credit in 2011, that would last until 2031. So somebody that received, a company that received a tax credit back in 2011 could potentially be filing through 2031 and receiving those benefits on an annual basis.
Okay, thank you.
Next question from Minority Vice Chair Wagella.
First off, thanks for presenting on something which is very complex. You did it very quickly, but I feel like I got a good grasp. I have like a million questions, but I'll start with this because of the Vice Chair's question. So the program was created by the legislature, but the agreements, are they developed through the MEDC and like the scope of those agreements? Is that correct to understand?
Yes, they ultimately enter into the agreements within the statutory structure that was set.
So like I guess where I'm trying to get at here is the idea of credits being able to be redeemed later on. Was that in legislation or kind of developed through agreements or a little bit of both is the understanding?
That was generally the structure of the agreements through legislation. How they would operate was generally accepted as here's the award, here's the agreement in 2010, for example, and as you retain these jobs over the course of the next 15 years, 20 years, there's a calculation that will calculate your credit in any given year, and you'll continue to file and receive that credit.
Okay, thank you. I have more, but
Yeah, I have a couple of questions for you, Ben.
Yeah.
It's my understanding from your report, you said that there are 10 companies who are receiving certificated credits still?
I think there's 10 certainly considered active at this point.
Correct. And if we look at the numbers, I saw on one of the pages it was 6.4 billion you had said, but they are paying under the Michigan business tax, which is 4.95% plus gross receipts 0.8%. Is that right? In most circumstances.
They're still filing under the MBT.
Right. So they are paying higher taxes than they would if they were paying under the corporate income tax of 6%. Is that correct?
Not necessarily. It's my understanding that when they calculate a liability for the credit, so when they're still filing under the MBT, they're going to calculate their MBT liability and their CIT liability, take the greater of the two, and apply the credit to that amount.
Right. And in most circumstances, that would be if they file under the MBT with the 4.95% plus the 0.8% of gross receipts. That would come up to more than if they paid under the CIT. But then that makes them eligible to get the mega credit, which would bring them to paying less in taxes, probably in most circumstances. Is that what's going on here? Can you just speak towards that for the committee?
I'm trying to understand your question, make sure I'm understanding your question correctly.
Well, so they're getting a lot of money in these certificated credits, but they may be paying more taxes in the first place under the MBT than they would if they paid under the CIT. Is that correct?
Potentially, yes. Potentially. I don't know how each calculation works out, but yes, it's potential. Like I said, they calculate both and take
Right.
the higher of the two. So if it were MBT, yeah, they would certainly be paying that on that liability.
Right. And then I guess my question I'd ask is if House Fiscal could look into those 10 companies and see what are they paying through the MBT with their 4.95% plus their 0.8% gross receipts, see what that number is, and then look at what are they getting in their certificated credit back, and what is that number they ultimately end up paying? What would they have paid if they paid under the CIT, and show the committee what the disparity is? I don't expect you to have that answer today, but if we could look into that, is that information that we could get?
I don't believe so, simply because it's private taxpayer information. That I don't have taxpayer filings and the ability to calculate sort of their liability under an MBT and a CIT, I guess.
So is there a way we could see how much they're getting back and capturing through the certificated credit and just compare to what they paid under the MBT?
I will ask some questions with the Department of Treasury and MEDC to see what information I can gather there.
Okay, thank you. I'll turn it back over to Minority Vice Chair Wagella.
I was just kind of seeking, I appreciate the breakdown of the cost of credits. Do you have a total number for the cost of credits already given plus estimated liability in terms of the program from its like birth till finish?
So the current estimate as far as the mega awards go over the life of the program was about $9.4 billion, according to the last report. And that's looking backward and forward.
Now, is that number been increased? I know that estimation's changed over time from what I could tell. Can you speak to what's been so hard to give accurate estimates and why they change and fluctuate so often over time with this program?
Well, I think back in around 2010 and earlier, I think there were assumptions around the value of the credit. Wasn't building in wage growth, job growth, that kind of thing. I mean, the difficulty is sort of the assumptions you make around whether they're going to meet the provisions of the credit, especially in a retention space where they may say you need to retain 10,000 jobs and make X investment, and the company only retains 7,500 or something. I mean, that sort of moves with economic conditions, so it's difficult knowing, sort of estimating that number forward. And I think that was the biggest issue. I think there were also issues around the timing of redemption prior to some of the changes that prohibited multiple filings within one fiscal year, causing sort of some revenue surprises. That was an issue that they have a time period. I think it's up to 4 years to file the credit after the fact. So if you get a company could have filed multiples within a given year. But so I think those were some of the bigger issues there.
Next question from Representative Potsky.
Thank you, Mr. Chair. Thank you for being here. I think that you covered all this. I just want to make sure that I understand it. So the credits are performance-based, not just based on the initial agreement, right?
Correct.
Have there been instances that you know of, this might not be a question for you, so I apologize if it's not, have there been instances where the credits were still given out despite the agreed upon metrics not being met? And is that, to your knowledge, is that where some of these amendments came into play after the fact, with the individual agreements, I should say?
I don't know that I can speak to that, whether any credit value was given out in exchange for not meeting performance metrics.
Great.
But I know that there have been amendments, throughout the 2010s to individual agreements to address, add flexibility, those types of things. But I don't know that that was in response to anything related to previously awarded credits for lack of activity.
Sure, and with the caveat that you don't know if that's because, there was advance notice that the metrics weren't going to be met. Did some of those amendments to the agreements in fact do things like lower the agreed upon wages or agreed upon job numbers or retention numbers or anything like that?
I'd have to go back and look at the amendments. There were wage changes. Some recent ones have increased the wage floors. They have wage caps on them, change location on where jobs can be counted, that kind of thing. But specifically to your questions, I don't know that I can answer without sort of giving a review of previous amendments.
Understood. Thank you.
Next question from Representative Bierlein.
Thank you, Mr. Chair. Thanks, Ben, for being here. So House Fiscal works with us all the time to plan the budget, to work on what the impact would be of new legislation. As we're trying to, go through mega credits and understand their value, or if they have value, if they don't have value moving forward, how do we be transparent with this? I mean, do we just have to rely on, what does MEDC provide you with so that you can forecast what the budget will, finances will be on mega credits 2 years from now, as we're planning?
So I would say there's a decent job of forecasting it now, especially with the limited number of credits. I think there's a general acceptance that they might hit their max awards. So it's like, as we forecast it, it's part of our revenue estimating conference with the Department of Treasury and the Senate Fiscal Agency. Also, it's included in the report. And I think if you were to look at our revenue adjustments in the revenue estimating conference, we align with the mega and certificated credit report when you look at the forward-looking credits and the value of those. Now, it may vary slightly, but I think they've done a pretty good job of at least being within the ballpark of what the value of those credits are in a given year.
If I may, Mr. Chair. And when they provide you with, when you're doing that forecasting, do you know who the 10 credits belong to, or is that private MEDC information and they just give you numbers?
The information has been FOIA'd and I think has been made public, at least of some of who the credit holders are these days. As far as the value of each individual credit, again, that is proprietary information for the company. We don't receive that. We sort of look at it as a gross total.
Okay. Thank you very much.
So for these 10 companies who are still getting certificated credits, it's my understanding that they have to provide W-2s to the Department of Treasury to show and to recapture back their personal income tax. Is that how the certificated credit process works?
Yes, to certify sort of the value of the wages and the health care paid as you go in to calculate that credit.
And the MEDC assists in that oversight and role to make sure that those W-2s are being put into the Treasury. Is that correct?
That's my understanding, that they partner, they work together in determining the value of those credits and ensuring that performance metrics are met at the level that the company's saying they meet those metrics.
And just for clarity for the committee, is this certificated credit that they're getting, or this money they're recapturing, is essentially the taxes that would be paid by the employees through their personal income tax? Instead of that going to the state of Michigan, they get to capture that back to the company. Is that correct?
Effectively, yes, because the calculation is wages plus healthcare benefits. So it's actually above it, because if you're including healthcare, which is not normally taxed under the Michigan income tax, to calculate your credit value, the amount you're receiving back is greater than the income tax on just the wages.
So the taxes that are paid by employees at other companies who are operating under the CIT, their personal income tax goes to the state and helps to fund state government operations. Whereas for these companies, if they get that personal income tax recaptured by their company, that just goes into essentially their profit margins to help them retain those jobs. Is that the general idea?
Yeah, CIT without tax credits, certainly those employees are paying income tax. You know, in the MBT, it's an amount equal to the income tax paid by those employees. But yeah, so effectively, you know, taking the covered employees under the agreement, the value of their income tax is certainly distributed back through the credit.
Okay, thank you. Looks like we have another question from Minority Vice Chair Wagella.
I appreciate you taking all the questions. So in Auditor General's report in 2017 found that companies receiving the mega credits had only created 48% of the standard new jobs that they had promised and 39% of high-tech jobs, and retained just 83% of the jobs they had promised. So my question is, how does when we discover things like that, and that's a big problem in my opinion, but how do we verify the claims that these companies are making in order to receive the credits? And then in that same report, just kind of pile these two together if you can. One of the things Auditor General's office pointed to as being an issue is that some of the agreements prohibited types of disclosures to the public and those outside of the legislature. Specifically, they referenced section 205.281F of the Michigan compiled laws. I don't know if that helps you know what I'm talking about, but I just was wondering more of like what types of information are not, is the public not allowed to see that the legislature can? And then also, how are we verifying that companies are actually creating the jobs that they say they are?
I'll try to answer all of those questions. So there is an extensive report in addition to the mega annual report that I talk about that sort of outlines at least some history by company of jobs either created or retained, and then there's some voluntary figures on investment. That serves as somewhat of a guide, and I think that's what the Auditor General had looked at when they initially did that. Two, I will say that if they didn't meet their mark, that was also reflected then in the value of the credit, because again, the way that multiplication works, since if you weren't meeting those numbers, the credit was lowered. It was based on performance. As far as information that we aren't able to see, individual company tax filings. So it's not something, you know, I as a member of the House Fiscal Agency don't have the ability to look at and confirm or deny like the value of a tax credit, but Department of Treasury and the MEDC do that. So they have access to that information. But we can't sort of independently verify that as an agency, I guess, in that sense.
So,
And there's been, you know, as you've seen, some information has become public that wasn't previously public, but that's sort of on a case-by-case basis.
can I ask a quick follow-up? So I think the issue I'm seeing with that is how do outside organizations beyond the Treasury and the MEDC and the company verify the work of the MEDC and the Treasury, right? Because I think the Auditor General's point was they weren't able to see that information, so they couldn't do an audit on it.
I don't have it.
Okay,
Sorry. Right, if they're denied information, I guess, you know, I don't know another route to seek that information, because I don't believe taxpayer credit or taxpayer tax information is foiable. Private taxpayer information is not foiable, but outside of taking the reports, the information that's provided and working with those entities that are able to sort of do the verification process, I guess that's what we're essentially left with in that regard.
I guess it does sound like it's a little bit difficult. We just kind of have to trust the process here a little bit to know that Treasury and the MEDC and the numbers that are going between the company and how many jobs they retained or created is correct. But it's difficult for you as House Fiscal to get that data, it seems, correct?
Yeah, I mean, we're not auditors. Certainly this information is audited on an annual basis, I would assume, to ensure some of this stuff is credit. But yeah, we're not privy to specific taxpayer information.
Right. Well, it looks like we have a question from Vice Chair Green.
So I'm just trying to wrap my mind around this. So we give out essentially billions of dollars without any verification potentially then. Because we don't know if there's employees, how much investment is. We just are trusting the company's data that they're giving to us to then analyze that they receive all that money.
I mean, the data they're providing is looked at by the Department of Treasury before they certify the value of the credit to ensure that those conditions are met within the credit.
But we can't verify any of it because it's all private information.
I can't verify what the Department of Treasury looks at. I can't see the same data. I would just say that the Department of Treasury can do that, but I, as a member of the House Fiscal Agency, cannot.
So what Representative Beerline said, we can verify employees, but then not investment. We can verify employees and their income through the Treasury, but we cannot verify the investment that the companies make that also goes into that calculation.
Yeah, I mean, I think there's documentation provided, and you will see, at least in the report, you could see some voluntarily submitted investment data, but I don't have the detail to go through and identify that.
And please don't take this. I'm not, you're doing an excellent job.
Oh,
Thank you so much
understand.
this is very complicated and you did a great job trying to help us get through the weeds. So I appreciate that.
Yeah, I'll definitely echo what Vice Chair Green said there. Thank you for coming in with this testimony. It is certainly a high-level conversation here, and you did a great job with your report. I would think if companies are needing assistance from the taxpayers, public assistance essentially, it doesn't mean that the private individual's W-2 needs to be exposed necessarily, but redacted information and clarity to be given so that we can vet and make sure that these numbers are up to speed is something that I think would be of interest to look into further. But that's a conversation for another day. I will turn it over to Minority Vice Chair Wagella for another question.
You've been nailing the name today, by the way. Anyway, I'm sorry I have so many questions. That's just how I roll, I guess. So there was an independent study done by Ball State and the Mackinac Center for Public Policy that found that each job saved or created by mega deals cost the taxpayer an estimated $125,000 per year. And slide 8. You outline that for the high-tech, high-wage jobs, they have to be at least 300% of the federal minimum wage. So that would be $21.75, I think. And the minimum wage federally hasn't changed for decades. So is it safe to assume that these deals have only gotten better financially speaking over time for companies because the lack of minimum wage growing, or is it hard? Do we have any data on, are the companies making more money than they're actually paying the employees through these tax credits? That's where I'm trying to nail down.
Then they're actually paying employees? That I don't know. I can't answer that specifically. I would only highlight that the way the calculation works is that the credit could exceed the income tax value that the employee is making because they do include healthcare. But as far as to your specific question, I can't answer that question.
And I'm assuming that's another question we couldn't answer or verify without some of the information that's...
Yeah, without some input from the Department of Treasury or MEDC.
Yeah. Thank you.
All right, seeing no further questions, thank you again for coming in today, Ben. Again, great presentation. We did ask some, I think, difficult questions as well, but I think it's important for everybody to remember that you are the House Fiscal Agency. These are not the decisions you made. You're just giving us the information as best as you can. So I appreciate you coming in here and giving us this report and answering the questions that we have here today. And we'll look forward to further conversations in further committees as we continue to discuss mega credits, as we hear testimony from other entities that are involved around this process. So we will be back again next week for further conversation. Seeing that there is no further business before the committee will stand adjourned.